Hello everyone, this is Modified Darvas Box coming at you here Sunday on December 5th. And I've got a short video why I think the S&P 500 SPX is headed to 4,300 over the next few months. So I've got a few reasons, but we'll put this out here and we'll see what you think. Quick housekeeping for anybody who doesn't know who I am. I'm an individual investor who created a system based on the book, How I Made $2 Million in the Stock Market by Nicholas Darvas. These are the two different covers. I believe that there's only three states of trend that exist in the market: uptrend, downtrend, and sideways. And I'm looking for patterns that look like this, bullish Darvas box patterns, and maybe to short or at least avoid bearish Darvas box patterns that look something like this. The goal of my strategy is generally to transact when the trend changes. But I've been doing this for 23 years, and so I've developed a number of different little tips and tricks. But anyways, we're talking about the S&P 500 here. So here is a weekly chart of the S&P 500. Now, as you can see, we've run into a little bit of trouble, but the index here has stopped roughly on the weekly moving average I use here. So it's, a little fair game to say, where is it going to go from here? My target is about 4,300, but not right away. Not looking for a crash, not looking for a quick zip down, but eventually maybe get around here, over the next few months. So, but here in the near term, yeah, it's bearish. We had a lot of volume selling, which you can see here. And honestly, I thought this dip that we're enduring now was going to happen earlier, back in here. I thought what's happening now was going to happen back here in September. It did not, for a couple of very good reasons. But let's take a look why I believe in this downside target. So it all comes down to earnings and forecasts. Now, I download this data. It's free. It's out there for the public. And I download it because it gives me the historical actual data for the S&P 500, and that's earnings data, earnings per share. And then it gives also a forecast. Now, it's very hard to forecast far in the future, so this one goes out to about maybe a year or so. And this orange line is where I think today's price, 45.38, I believe it's looking at this data point here because it's not quite focused on today, but it's looking out maybe six months in the future, maybe 9 months. You're looking at the future and you're reacting now. So let's see here. The index closed at 4538.43. And this quarter, which is going to end here at the end of December, is currently earning $49.65. And that's the aggregate of all 500 stocks in the S&P 500. Now, right here is the differential from getting the most recent data and what it was last time. So I downloaded it here as of the latest one as of December 2nd. So the estimates, the new data, declined. Well, actually, it increased 0.07%, but the near-term quarters did decline a little bit. Nothing major. But here's the percentage growth. And this is why I think the S&P 500 is turning downwards, because we're going from a period of rebound growth, and now our future here is going to be flatter, lower growth. And look at that, 3%, 5%, 4%. If you average all of these up, we get to, where is it? Formula function average. If we average these up, we get to about 7% growth over the next 1, 2, 3, 4, 5 quarters. 7% growth isn't all that great when you look at how the index is priced on PE basis. Look at it on trailing, backwards looking PE. which is right now 23, 25, 23, etc. And then we look at it on a forward basis going forward, looking at the future. That's about 21, 22. Call it 22. So right now they're pricing this growth, future growth, at a 22, 23 level. Now, do we know whether that's high or is that low? Is it a bargain or is it overvalued? Well, I created this handy table based on historical PEs. This shows that a PE roughly over 25, yeah, it's generally considered a bubble. And we know from history that the Great Depression bottomed out at a PE of about 8. So basically, the levels in between, this is what I came up with, and this tells us, what kind of a market. Yeah, has it been strong? Yes, it has. And you can see how the index has been priced, 22, 24, 23, 22. They've generally kept it along this level. And I think we could all agree that it's been a strong market. So now, why do I pick 4,300 as the new level? Well, we know that the average growth here over the next 5 or so quarters is going to be about 7%. And in my opinion, 22, 23 is probably a bit high because 7% growth doesn't really reflect a strong market. So here's how I get to that target. Let's start playing with the numbers. If I type in 4,500, S&P 500 drops to 4,500. Well, now the numbers, the pricing changes 21, 22, still a little high. 4,400, 22, 21, still in that strong market range. Still a little high for that 7%. Aha, now 4,300. Now we start getting into a 20 level PE at 4,300 based on the future numbers here. And this range going to average market for average growth. So yeah, 4,300, that's pretty much my target. We could go lower to 4,200, maybe in a panic or something, because you see how that changes right there to 20. But we have to also remember that the Federal Reserve might panic and stimulate really hard. God knows what they can do, but the impact of the Fed can be, quite enormous, as we've learned. So let's say they stimulate and these numbers all go up. Well, guess what? That means that these numbers here will decrease naturally on their own. The more earnings the index makes, the more we do not have to drop the price in order to drop the valuation. So that's why I chose 4,300 based over the next few months. And you know what? That's only a 5% drop. It's not the end of the world in the S&P 500 index. Now, a lot of stocks are struggling because guess what? They are not in the S&P 500 index, like software stocks, technology, etc. But this is how I use this spreadsheet and comparative PE analysis to come up with a target. Now, it's subject to change because these estimates change regularly. And the reason why I thought this range back in September was when we would start dropping was because if you go on Twitter and you type in my handle in SPX and go to latest and go to November 6th, you can see here it was pessimistic, but then right here the estimates jumped huge. It was this jump in estimates was so big that literally I was pinching myself wondering, can this be real? Well, it turned out to be real. And what happened? That bump in estimates caused the market to move higher. Well, now we don't have a bump in estimates now. It could happen, but that's what I believe we're seeing right now in all this weakness. And again, 4,300 might put it here, about here or so, not the end of the world for that level. The way I handle this on a Darvas box trading strategy is you would have been buying it here at this level at the top of the box. And there's your line, which is, hey, this trade isn't working. We should exit. That's your last resort stop loss. Unfortunately, it has hit. So now it's reevaluate and wait for a new Darvas box to form. And maybe the signals will be for up. Maybe those signals will be for down, but we'll just have to wait and see what happens. So hopefully this makes it pretty clear on my target as to why I believe the S&P 500 is headed to 4,300 over the next few months. Hope you enjoyed the video. Talk to you soon. Bye.